Let's take a look at this intra-equity transaction consolidation problem. It's problem 5-20, and I'll read it for you right there, okay? Penguin Corporation acquired 80% of the outstanding voting stock of Snow Company on January 1st, 2012 for $460,000 in cash and other consideration. All right, let me move that away, and we'll continue reading. At the acquisition date, Penguin assessed Snow's identifiable assets and liabilities at a collective net fair value of $665,000, and the fair value of the 20% non-controlling interest was $115,000. No excess fair value over book value amortization accompanied the acquisition. Okay, so they've made that part simple for us. And then they give us the following account balances from the records of Penguin and Snow. Remember, P is the parent, S is the sub. Okay, so they're making that a little bit easy for us. Now, let's look at part A of this problem. It says, assume that Penguin, that's the parent, sells to the sub, that's Snow, inventory to markup equal to 40% of cost. Intra-entity transfers were $104,000 in 2012 and $124,000 in 2013. Of this inventory, Snow retained and then sold $42,000 of the 2012 transfers in 2013 and held $56,000 of the 2013 transfers until the next year, 2014. And then what we're asked to do is determine the outstanding balance that would appear on the consolidated financial statements for cost of goods sold, inventory, and non-controlling interest in the subsidiary's net income. Okay, let's work on the consolidated cost of goods sold first. And what we do is we go through the various steps. Now, the first thing we do is we add together the parent's cost of goods sold and the sub's cost of goods sold. Okay, and when we do that, we get some value. But we're going to go on to the next step. We need to eliminate the 2013 intra-entity transfers. And if we read up here, I think they tell us how much it was. Okay, now I put the problem back up there where you can see it. And we're taking care of the consolidated financial statements for 2013. So right there it says $124,000 was sold or transferred, if you will, right, in 2013. So we need to eliminate that. Okay, and then we need to reduce the beginning inventory because there was unrealized gross profit on it. All right, so they sold $42,000 in 2012, and we have to figure out the markup percentage, and I think it said 40%. Let's see if we can find that. Yeah, right there, 40%. So we've got to do an elimination of the beginning inventory. Okay, so the 42,000 divided by 1.4 will get you the equivalent of knowing how much was the unrealized gross profit. Actually, the 30,000 tells you what the cost was, and then the difference between the 42 and the 30,000 is the gross profit. Okay? So you can divide by 1.4 to determine the cost. Take the 42,000 less the cost of 30,000, and you've got 12,000 that was unrealized gross profit sitting on the books in beginning inventory. We need to eliminate that. And then we need to consider the ending inventory. Now, in the ending inventory, they tell us 56,000 was held until 2014. So we're going to do the same type of calculation. We're going to take the 56,000, divide it by 1.4 to come up with what the cost was on the ending inventory. Okay, so we take the 56,000 less the 40,000 to determine the unrealized gross profit. Now this one we have to add it back. All right, now the reason we're adding it back, and by the way, I think that should say 2013, not 2011. The reason we're adding it back is because we eliminated all of the sale at first. Okay, so these are, you can think of this as we eliminate all the sales, then we figure out what the adjustments are we need to do with the gross profit in beginning inventory and the gross profit in ending inventory. So when we're done, we're able to compute that consolidated cost of goods sold should be $507,000. Now, as you work through this, remember that every one of these is an elimination entry, right? You not only have one side, but you've got to make the entries to both sides. So although this problem is only asking you for one side, it's important that you know what you're going to debit and credit on the elimination consolidation worksheet to come up with that 124 and that 12 and 16. Okay? That's how we come up with the consolidated cost of goods sold. Okay, next I'm going to show you how you would come up with consolidated inventory. And this one is a bit simpler once you've done consolidated cost of goods sold. We're going to add the book value of the inventory of the parent. Okay, that's the 360, and the book value of the inventory of the subsidiary, that's 124. And then we need to back out the deferred unrealized gross profit. And keep in mind, we're making those entries, so it will just fall out when we're doing this on a spreadsheet. All right, let's look at that last answer. There's 16,000. That 16,000 was the deferred unrealized gross profit. Okay? And your entries should show that and work out to that amount. And then finally, I want to show how you would compute the non-controlling interest in subsidiaries' net income. And you see that on the bottom of the screen. Now, in this case, all the intra-entity sales were downstream, so there was no deferrals that impacted SNO. Therefore, the non-controlling interest is simply 20% of the 114,000. That's the revenues minus the cost of goods sold and expenses of the reported income, 22,800. Okay, and I just entered that here in Excel. In fact, I probably should bring back the cells so that you can see this is just, me entering it in Excel. It doesn't want to behave how I want. Let's put the lines back in. Let's see, just get rid of this, no fill, and you can see the lines now. Okay, and so all I've done is dropped in the numbers above. The 500 less the 267 less the 119 gets you 114 of income, and 20% of that is the 22,800. Okay, and that's how you solve the non-controlling interest in the subsidiary's net income. Keep in mind, though, if you're making these transactions, most of this you'll be able to see on the worksheet, and that's probably the best way to approach solving these questions. Go ahead and make up all the entries as you go.